Okay, welcome back to the second PowerPoint in chapter 13 on theme 4, making markets work, and we're going to be looking at monetary policy here. We remember the last session we looked at fiscal policy. We're looking at monetary policy now. So, a quick definition of what monetary policy is. It's basically the manipulation of the rate of interest, the money supply, and exchange rates to influence the level of economic activity. Now, on the basis of that, the fact that you've got interest rates, exchange rates, and economic activity, you can see how they are essentially interwoven. So, rate of interest, the level of money supply, and also exchange rates can all be influenced by interest rates, as we'll see as we go through the presentation. So, let's move on. So, in terms of the goals of monetary policy, then, there's a couple of things I want you to consider. There is a short video on something called forward guidance that I'd like you to. It's about 3 or 4 minutes long, provided by the guy who was originally the Governor of the Bank of England, a chap called Mark Carney. And it just explains a little bit about what forward guidance is. So take a look at that and then take a few notes on that too, okay? But in terms of monetary policy goals, then, the primary target of monetary policy is to maintain a low rate of inflation, to control inflation. That's the main goal of monetary policy. The target, as we know, is 2% inflation. So we allow the government and the economy is quite happy to have a small amount of inflation, but we don't really want it to get out of control. So 2% is the nominal target for the rate of inflation. In terms of monetary policy, as I think we've mentioned before, although the government used to control monetary policy back in the late 90s, I think it was, Bank of England basically were given delegated responsibility for managing interest rates, setting interest rates known as the base rate, and also for controlling the money supply. So effectively, the Bank of England have been charged with managing the money supply, and as a result also managing the rate of inflation, or trying to control the rate of inflation. Clearly, the other thing that it also does as a result of that is to try to provide an environment, an economic situation where there is going to be growth and higher levels of employment. And over the course of the last sort of 10, 15 years, you can see that they've done a pretty good job in helping to manage that whole process. So, how does monetary policy work then? There's a monetary policy outline from the Bank of England that you can take a look at, which is in that document there. So go and take a look at that. But in addition, this just breaks it down in a little bit more detail. Okay, so the bank basically run each month a monetary policy committee, and that's when they decide the level of interest rates and any other changes to policy strategy. So more often than not, if you're listening to the news or economic news in particular, there will be an announcement from the Bank of England about what they're planning to do with interest rates, and they'll be looking at lots and lots of stats and information about where the economy is going, about where they feel the economy needs to go, and they will then decide what interest rates are. Okay, so we'll look in a little bit more detail about how interest rates work in a minute. Now, clearly, there's a number of things that they will look at and consider, a number of macroeconomic variables that they're trying to help manage. One is GDP, the level of gross domestic product, the levels of unemployment, what exchange rates are like, what house prices are like, and the level of investment in firms. So it's all about trying to anticipate where the market might go in the future, and then in some cases trying to help manage that whole process. So keeping interest rates low clearly should encourage more people to borrow money, and hopefully more people to invest, more businesses to invest in future development and growth. The main tool that's used is the manipulation of interest rates, but there is another thing that you will certainly be familiar with, although it's a fairly modern tool and not quite as important as interest rates, but it has become more and more important over the last few years, and that's something called quantitative easing. Okay, Now, that's quite a complicated concept to sort of get your head around, but there are some quite nice short videos which explain what quantitative easing is and how it works, and I'll point you in the direction of those in a minute. So the whole principle is then, if we can maintain this inflation rate at around about a 2% target level, that gives a massive amount of confidence, both business confidence and consumer confidence, which hopefully then will stimulate further growth and development. Okay, so consumers, obviously, in terms of their spending decisions. Now, clearly, the one thing that you don't really need is inflation raging at 7, 8, 9, 10%. And then the real value of your money, the money in your pocket, basically starts to fall. So if you can keep it at around about 2%, that gives consumers confidence regarding any of their spending decisions. In terms of firms, clearly it helps them decide on their investment decisions. Again, if there's relative stability in the marketplace and there appears to be some positive consumer and business confidence, that clearly is going to make a difference to economic growth and development. And obviously workers too, in terms of wage demands. If you've got raging inflation at 7, 8, 9, 10%, then workers are probably going to be saying, well, we need at least that to keep pace with where inflation is. So you can see that there's a massive positive to maintaining a consistent level of inflation and managing that around that target of 2%. So a bit more about the Monetary Policy Committee then. Excuse me. So they are the outfit, the organisation, the committee responsible for setting interest rates. There are 9 members, 4 are independent, 5 are from within the bank, chaired by the new Governor of England. Picture of Andrew Bailey there, who took over, I think, in the last year or so, from Mark Carney, who was quite a high profile in terms of his governorship of the Bank of England. And effectively, what the MPC do is meet monthly and look at the state of the economy, see whether they're going to increase, decrease, or hold interest rates at their existing level. And it is independent from government. Although clearly they're inextricably linked, the actual decision is made by the Monetary Policy Committee, and that independence was supposed to depoliticize the process of interest rate changes. Okay, so clearly quite an important principle there. In terms of interest rates then, and this is something that I'd like you to have a little go at completing the table. Effectively, if you think about it, interest rates is essentially the price of money. So there are some winners and some losers when interest rates change. Okay, so clearly interest rates are the rate that you get charged if you're borrowing, but they are the reward if you are saving money. Okay. And so you can see that we've in the table here, we've got a number of different options in terms of high or low interest rates, and whether that would then have an impact on consumer saving, consumer borrowing, investment, and house prices. So I'd like you just have a think about that. Think about how interest rates might affect key purchases and the key purchases that we might all make in the future, and see if you can come up with whether you think high or low interest rates will have an increase or a decrease in consumer spending, consumer borrowing, investment, and house prices. And a process of elimination is probably a good way to go, because it will become fairly clear, hopefully. So have a go at that and see how you go. If we take a look at interest rates historically then, as you can see, significant changes really since 2008, 2009, where effectively for that period of time, or before that, be from 2006 through to, well, really 2009, we were talking about 4-5% interest. Interest rates were pretty much the norm, and as you can see, they sort of climbed from a low in 2006 up to a high of just under 6% at the start of, or just end of 2007, really, and then significant. Well, it almost fell off a cliff, if you like. It almost looks like a cliff there, doesn't it? And no real surprises that happened around about 2008, 2009. Okay, so you can see in this situation, Oh yes, 2016. Sorry, I do apologise. I was looking at, thought it said 2006 there, and I thought, well, that doesn't look right. So in this situation, then you can see the charts, the chart of interest rates over the last decade or so, and from 2016, the interest rate in August was cut to 0.25%. Um, you can see it's been very, very low, really, since that period of time, since the financial crash, if you like. But think about the reasons why that might have been done. What sort of things do you think would happen to aggregate demand if interest rates are at a very low rate? Um, and why do you think that those rates have stayed low for so long? And also, go and find out what you think the current base rate is, because it's actually even slightly lower than the last recorded value on this particular chart. Okay, so have a think about that and try to rationalize the reasons for that. Let's take a look at, there is obviously a very strong link between interest rates and the exchange rate. Now, I haven't really looked at exchange rates in any great detail, but hopefully it will make some sense, and we'll talk about that in a minute. So there is a big link between the two. Okay, and we'll try and explain what the link between interest rates and exchange rates are, or is rather. Okay, now if you think about it, if you've got a global investor, so anybody with some money to spend or to try to make some money from, make more money from that money. So where you've got global investors, they will have large amounts of money in deposits in banks, and they're going to seek to try to get the best return that they can. Okay, so where interest rates are at their highest. Okay, so clearly, if you've got high levels of interest rate, then that is going to make your country, relative to other countries and other currencies, that's going to make your country more attractive for those global investors. Excuse me. So if we assumed, let's take a scenario that we've got the same interest rates as the USA, then for the investor, that the return is the same whether they deposit their money into the UK or the USA. If we then raise our interest rates and the US keep their interest rates at the same level, then investors will likely to move their money into the UK in order to get the best return. In order to do that, they essentially would need to, in this case, if they were US investors, they'd need to sell their dollars and buy pounds in order to make a deposit into the UK. Now, that effectively means that there would be a greater demand for UK pounds. And because there's greater demand, that would essentially increase the exchange rate. So it would make the pound stronger in terms of its value than the dollar relative to the dollar. That obviously then affects all sorts of other areas. So if you think about on the face of it, well, okay, you can understand the link between uh, more people wanting to invest in the UK and that increasing the exchange rate. But also, if we think about that, then how that might affect other parts of the economy, that would feed through to affect exports, which would make them relatively less price competitive and make imports more attractive because of that change in exchange rate. And clearly, that is something that the government has to bear in mind, and also the Bank of England have to bear in mind, because it's not just a simple case of changing interest rates. It's also thinking about how is this going to affect other key things within the economy, like this in this case, exchange rates and then imports and exports. Now, if that does happen, as we said, if we have this increase in exchange rate, we get less exports being sold and more imports being bought. That's going to then affect the balance of payments on the current account, which is basically the difference between imports and exports. So if we get even more imports and less exports, that's going to mean we're going to have a worse position for our balance of payments as far as the current account is concerned. And this process, where effectively what global investors are looking for is the best return they can get for deposits in their banks, is sometimes known as hot money. Okay, so effectively international funds that move around the world, which are effectively chasing the best interest rates. So there's a little bit of speculation on these investors' parts, but actually, when I say speculation, it's not speculation really. It's waiting to see which country has its higher level of interest rate, and then using that as a means to actually deposit large amounts of cash that they got swirling around, and making more money as a result from their deposits because the interest rates are higher. Okay, so that's a little bit about interest rates. This is really talking a little bit more about quantitative easing now, also known as asset purchases to increase the money supply. And there's a nice video which explains how QE works that I'd like you to take a look at, which is by clicking on here. It's basically quite a nice article about quantitative easing and the way the whole process works, but also there is a video attached too. So, in terms of what QE is, quantitative easing, also known as QE. So, it's a relatively new phenomenon for the UK. Only really started around about 2008 when we had the financial crisis. Okay, so one could argue that during that time, and clearly, well, they did. The Bank of England dropped interest rates significantly in order to help stimulate economic activity, and the hope was that that would be sufficient to encourage more spending and for us to come out of recession via an increase in aggregate demand. However, even with those very low interest rates at about 0.5%, there was very little downwards movement in order to manipulate the economy with any further. And actually, as history tells us, that historically low interest rates didn't make that much difference to the amount that people were borrowing and spending, simply because I think of the fragility of consumer and business confidence. So, in addition to that, and other things that were that caused that twitchiness, if you like, was the fact that banks were very nervous about lending money to firms and individuals because they'd been caught very much out by the whole issue of the global financial crisis. And so, in order to sort of step into the gap that was created by that, the Bank of England also sought to boost funds available for lending to businesses and firms, and so effectively quantitative easing was born. Okay, now over £375 billion has been raised in terms of quantitative easing, and you'll see when you take a look at the article that I mentioned here, the latest pandemic is actually going to make it significantly more than that. Again, one of the arguments is, has this been effective or not? One could argue that other things that have been going on have actually helped too, but certainly the argument is that the recession that we had as an immediate consequence of the global financial crisis would probably have been significantly worse had the Bank of England not effectively stepped in to try and intervene and make a difference to the amount of spending that was happening in the economy to try and drive economic growth upwards and to bring us out of recession. So let's take a look then at some of the other principles to bear in mind. Okay, so if we're looking at the impact on changing the levels of AD on the economy as a whole, clearly thinking about the levels of aggregate demand, one thing that is clearly going to happen in terms of consumption is if we actually lower interest rates, there's less incentive to save, more incentive to borrow, and as a result of that, there will be more consumption, a higher level of consumption, which is obviously one of the biggest components of aggregate demand. That's clearly going to affect general spending and consumer durables, especially, particularly when you think about it. In most instances, people are borrowing money to finance large purchases, like, for instance, cars or white goods, furniture maybe, and also possibly housing. If we take the opposite, though, if we've got higher levels of interest rate, the opposite is the case, okay? So there's a greater incentive to save, less incentive to borrow, and so as a result of that, that's going to lower consumption. So you can see in this instance, depending on whether we're going for higher or lower interest rates, that can have a fundamental effect on consumption, and as a result, aggregate demand too. If we're talking about investment, which is one of the other areas of aggregate demand that has a huge influence, again, lower interest rates are going to mean that investment projects are going to become less costly, and that's going to mean they're going to be more profitable and, as a result, more attractive. And so investment levels should rise when we have low interest rates. If we have high interest rates, the opposite happens, okay? So effectively we'd have less businesses borrowing money, and as a result of that, less businesses would be looking to invest and expand their businesses. We then take a look at net exports, which is basically the difference between exports and imports. If we have low interest rates, okay, we have a weaker pound, and as a result of that, and the reason for that is because it's less attractive for the hot money or the currency investors to invest in. But that essentially would mean that a weaker pound would mean that we'd have stronger exports. Now, we've talked about SPICed and WIPIDEC, and SPICed is included there. The acronym that hopefully should allow you to remember that a strong pound means imports are cheaper, exports are dearer. And WIPIDEC is where you've got a weak pound, imports are more expensive, and exports are cheaper. So there are some advantages and disadvantages to the way in which interest rates can have an effect on exchange rates and net exports. Remember, net exports is fundamentally exports minus imports. In the UK's case, we have almost always have a negative net export figure because we import so much more than we export. But even so, the difference between the two figures can be significantly changed by the level of interest rates and exchange rates and how they're affected. And again, same principle. If we have high rates, the opposite applies. Okay, exactly like we said, the SPICed principle: stronger pound, imports cheaper, exports dearer. So let's take a look at some diagrams in the same way as we did when we looked at expansionary and contractionary fiscal policy, and let's see how monetary policy could be used to control inflation and also unemployment. So let's take a look and break it down. So we've got a situation where the Bank of England is concerned that slow economic growth is likely to feed through to lower inflation, and that they may choose in that case to cut interest rates. So this would be expansionary monetary policy. Okay. So again, remember, always label your axes. Make it as clear as possible. Make sure you've got your equilibrium point in there, and also draw up exactly where these scenarios are. So Y clearly would be the point at which aggregate demand and long-run aggregate supply are in equilibrium, and then FE is our full employment level of real national output. Okay, so in this situation then, if this happens, if the Bank of England decides that there's slow economic growth and they want to try to improve matters and try to stimulate some more economic growth, then they may well cut interest rates. Okay, now that's going to reduce the savings ratio, which is basically the tendency for people to save rather than spend, because that essentially makes borrowing more attractive. And then as a result of that, if we've got lower interest rates, more people borrow more money. That means they're more likely to then spend money as a result, and consumption will increase as a result. Let's take a look at how that might be affected in terms of the change in aggregate demand. So there'd be an increase in aggregate demand from AD to AD1. And you can see that and in this first instance, we've got output at Y and at the price of P. Okay. With this change in aggregate demand, you can see that we've got an increase in real national output to Y1. Okay, and we've also got a slight increase in price to P1, which is obviously both advantageous in terms of firms and businesses who are able to sell their product for slightly more, so a higher price, but also they're also able to produce more. Okay, so real national output would actually increase from Y to Y1, as mentioned before. And that clearly would also benefit, because that increase from Y to Y1 would be reasonably significant. Then businesses and firms, in order to satisfy that new level of demand, would also be looking to create new jobs and obviously create more employment, which is obviously going to be good for all concerned. Let's take a look then at how contractionary monetary policy might work. So in this scenario, again, same principles. In this case, the Bank of England is concerned that inflation is running at above 2%, the target that they'd set, and they may increase interest rates in order to reduce inflationary pressures. Okay, so in this scenario, we've got a picture where, or a diagram where our LRAS curve is at full employment, okay, and our aggregate demand curve is also at crossing the LRAS at that point. Now you can see that effectively, if we've got full employment, then that means that all of our factors of production are being used to the maximum. So any increase in aggregate demand is just going to cause inflation. It's not going to mean that we can produce any more in the short term. And as a result of that, what the Bank of England might do is to try to actually encourage more people to save rather than spend. Okay, so in that scenario, increasing interest rates is going to make it more attractive to save, and it's also going to reduce consumption because it's also going to mean less investment from firms because it's more expensive to borrow money. What would essentially happen there, as you can see, is aggregate demand AD would move and shift to the left and downwards to AD1. And you can see also that effectively output would be reduced slightly from FE to Y1. And also you can see that our new equilibrium point would then also reduce our price from P, the original P, down to P1. That clearly, that reduction in price is going to reduce inflationary pressures too. Okay, so you can see that that change would then mean that prices would fall. However, the issue is that if that does happen, and this is where the balancing act comes in, if we were to get into that situation, we've got the expense the expense of that reduction in real national output to Y1 could damage economic growth and also employment, because clearly, if we're having less amounts being demanded as a result, that could then mean that businesses might choose to either reduce their level of staff and also reduce their level of output, which obviously is then going to have an effect on growth, economic growth and development. So let's take a look at some of the strengths and weaknesses of monetary policy. Okay, based on the two diagrams that we've shown there, and also some of the others that you'll be familiar with, think about what the strengths and weaknesses of monetary policy are, and it obviously depends on a number of things. Okay, so again, the size and change of the change in interest rates will clearly vary the impact. So if we have a relatively small change in interest rates, that's probably not going to have a massive effect. But if we had a very big change, that could have a fundamental change and fundamental impact. The timing of the rate change is clearly also important, and part of the reason for this principle of forward guidance that the Bank of England have brought in is to try to make sure that businesses and individuals are aware of where interest rates might go and what the Bank of England is thinking is going to happen. So that forward guidance is almost like an early warning shot for businesses and individuals to appreciate what's going to happen. Clearly, the size of the multiplier again, and the multiplier effect of any change in investment levels and any input into the circular flow of income is obviously going to be affected by the level of the multiplier. And also, other things that are going to have an effect will be the stage of the economic cycle that the economy is at when this change might be happening, when this either contractionary or expansionary policy might be introduced. We also borne in mind, and we keep coming back to this, that some of these relatively blunt instruments that the government has at its disposal do take some time. Okay, so it's all well and good saying there's going to be a change in interest rates, but that then there is quite a big time lag between that change happening and it taking some sort of effect that is going to be shown within the economy. And clearly, when we're talking about monetary policy specifically, it tends to be focused on managing and controlling inflation. However, we know that there are other targets, other objectives, that the macroeconomic objectives that the government is trying to achieve, and in some cases, that control of inflation may actually conflict with some of the other objectives that the government is setting for itself. when the Bank of England is deciding on monetary policy and how they're going to implement it, maybe some of the data that they're using could be poor or inaccurate, and that could be something that could affect the quality of the decision making. Although, having said that, they seem to have done a reasonable job over the last few years, as we've said, in terms of meeting their targets for managing the inflation rate. Another thing to bear in mind, and this is almost when we're starting to try to evaluate monetary policy now, interest rates will solve demand pull effectively if inflation is being created by higher levels of demand. Then clearly by increasing interest rates, we can then take a look at the effect that would have, and it would actually certainly depress demand and so solve the problem of demand pull inflation to a point. However, it's not necessarily going to have the same effect on some of the cost push causes where the cost of production are being increased for businesses, and that effectively then is the thing that's driving prices upwards rather than demand. Okay, there's a number of multiple choice questions. I think there are 5 that I'd like you to take a look at, and these are all to do with monetary policy. So again, have a look through the questions, have a go at answering them, and we can go through that in the online catch up when we catch up later on in the week. So one slightly longer question there, which again is making sure that you're reading the question and then try to eliminate some of the more obvious ones that can't be the correct answer, and then take a view from there. Another one there on large rise in interest rates, and then also talking about a negative output gap, which is something we're going to look at in a minute. And finally, consequences of an increasing the interest rate when exchange rates are rising. How is that going to affect each of those areas? So let's take a look then at the next area, which is how investment, job creation and economic growth can be encouraged then. So clearly, some of our demand side policies can encourage and should encourage investment, job creation and economic growth. Okay, so if we're thinking about some of the reasons why that might be, if we've got low interest rates, it's going to make it cheaper for us to borrow money, and therefore finance is going to expand. If we think about that then in terms of the firm's interest payments are going to be lower, that's going to make them more profitable, and that hopefully means more retained profit will be kept in the business, and that would then be available for further reinvestment in the future. Again, if we've got government spending and lower taxes, that's going to lead to an increase in demand and greater confidence in the economy. And clearly, if we've got greater confidence, more people consumers are going to spend more, consume more, and hopefully that's then going to mean an increase in the size of businesses, which is also going to add more employment too. And that's clearly going to lead to more firms being willing to invest in the future. Okay, so in terms of some of the other things that other implications and how that can be encouraged, if we think about this and take it step by step, if we got high levels of confidence, the economy is going to grow, and firms are prepared for the future. They're going to take on more workers and then create more jobs. So in the long run, firms are more prepared to invest in projects when we've got a very positive economic outlook. That's clearly then going to lead over a longer term to an increase in productive capacity of the economy. We're going to have new factories, new machinery, hopefully better training. That means that essentially our long run aggregate supply should increase, means we've got greater productive capacity in the economy, and that should lead to economic growth and hopefully further economic development as a result. So we get economic growth. We talked very briefly about time lags, and we're just going to go through that in a little bit more detail. And clearly, it is a big issue. Whenever you're talking about any macroeconomic policy that the government is trying to implement, time lags is always a good evaluative statement to make. Okay, so it's basically what a time lag is where there's a delay between a policy being implemented and it actually having some sort of effect or outcome. So most policy decisions will take some time to have an effect for a number of reasons. One, firms tend to sit on their hands a wee bit and wait for the impact of government policy. Lots of businesses will have long-term contracts in place, so if there's a change in the interest rate or a change in exchange rates or whatever, that won't necessarily affect any decision making in the short term. So effectively, as we've said before, in some cases it can be, they reckon that an interest rate rise doesn't really show until about 18 months after the interest rate change. Okay, so that's clearly meaning that there's a significant amount of time that elapses between announcing a policy decision and then the effect of that having an effect on the economy and having the desired effect that the policy was set out to do. Okay, now there are always going to be trade-offs. Okay, so if you think about it, demand-side policies will have some built-in trade-offs, and let's look at one example then. Okay, if we've got expansionary policy going on, so we're essentially trying to stimulate more demand, that's going to mean that we get higher output, and if the expansionary policy is successful, that we're going to get higher output and lower unemployment. But the expense is going to be, that's the danger of expansionary policy, is that's going to be causing higher inflation. So again, this trade-off between what are we going to do? Are we going to go for higher output and lower unemployment and then just manage the inflation implications later? Or alternatively, another example, if we have tight fiscal policy control to control inflation, okay, or to help control inflation along with some monetary policy, that is then going to mean that the danger is that if we get to a point where we're so tight on our government spending and taxation, that effectively that could mean that we would increase unemployment and damage the level of gross domestic product, with the danger of us possibly going into recession, of course, where we have negative growth over 2 consecutive quarters. So there are links between these objectives, as we'll see, and there'll be a couple of examples that I'm going to show you, I'll talk to you through in a minute, and also some of the conflicts that we might face too. Okay, so we're saying that in some cases, if we achieve one objective, that can often lead to other objectives being met as well. So let's take a look at the first example then. Okay, so government decides it's going to invest in education and training. That's going to lead to more skilled workers who can be more productive and produce higher quality goods and services. They can be potentially exported at more competitive prices, and that's then going to improve the balance of payments. Because that's an element of the aggregate demand, that's going to mean greater economic growth will occur, and that's going to turn into more jobs and lower unemployment. So you can see that one thing, investment in education and training, could have a fundamental impact on a number of the other objectives that we might have set for ourselves, okay, as a government. We take a look at the second example then. Okay, Bank of England is consistently meeting its inflation target, and that essentially is going to provide a very stable environment where firms are going to be more confident to invest. That's going to lead to higher capital spending, and that's going to boost the long-term productive potential of the economy, helping to reduce unemployment and also helping to enhance the competitiveness of UK exports. And that then has an impact on the balance of payments as a consequence. So we get more exports. That's going to mean that our net trade figure, our net exports figure, is going to be significantly improved. So you can see that one simple policy that actually, or one objective that has actually helped to achieve one of the macroeconomic targets will also have an impact, a positive impact on some of the others too. However, we can also have a range of conflicts, and we sort of touched on this already, but let's just take a look at this in a bit more detail. Okay, so there are a number of conflicts that can occur through economic decision making. Let's take a look at the obvious one, unemployment versus inflation. Okay, so if we create unemployment through less government spending, that means that we will get a fall in demand, and that's going to lead to lower inflation. However, let's take a look at another one. So economic growth versus the balance of payments. If we've got a policy of growth, if we're talking about expansionary fiscal policy, that's going to lead to higher employment and greater demand. that higher income will increase consumption, and that obviously will then be a part of which of that is spent on exports. So that is essentially then going to cause uh, lead to a deterioration in the balance of payments. Actually, I think that should be the higher income that's going to be more spent on imports, not exports. I do apologise. That should be imports. I'll change that on the slide, but that should be imports. But if we then take a look at economic growth versus inflation, then we may have a positive output gap, and that could lead to increased demand and resultant inflationary pressures. We're going to talk about positive and negative output gaps in a minute, as we'll see. So, clearly, one of the things that policy decision makers have to do is bear in mind that there are a number of side effects on any policy choices, and trying to balance that and give a balanced view, take a balanced view, is clearly quite an important principle to get right. Let's take a look at this principle of output gaps then, and how that might affect inflation and unemployment. Okay, so we've got basically our booms and slump of the typical economic cycle. And you can see that we've drawn a trend line in here. So we've got actual GDP and the fact that it's going up and down on a fairly regular basis, as any long-term forecast or any long-term view shows. But in this instance, we've drawn a trend line in here, and then we're looking at, in some cases, a negative output gap or a positive output gap. I'll explain what those are in a minute. Okay, so basically, a negative output gap occurs when the actual output is below the trend rate. So you can see the general trend rate in this case is pretty much upwards and a fairly positive. But clearly, in this instance, we've got a negative output gap. So that's the point at which our actual output is below where we think it should be. We're not actually having to produce as much output, because maybe there isn't sufficient demand to justify that. Okay, so that low demand means that there is going to be a reduction in inflationary pressures, and as a result of that negative output gap, we're going to get lower demand, and that could mean cyclical unemployment will occur, because we only need to be performing at this level here. Okay, and that essentially means that we may not need as many workers to provide the output that we need to satisfy all the demand. So in this situation, the economy would be in a recession, operating at point X. Firms don't need to employ as many workers because they wouldn't need to produce as much as they had done previously because of the demand falling. Okay, so that's a negative output gap. When the economy starts to recover and gets towards a positive output gap, so as an example here, that would be a positive output gap, because here actually we're producing, or there is sufficient demand to actually satisfy the demand is outstripping supply. So effectively, in that scenario, we'd have a positive output gap and cyclical employment would reduce. Let's take a look at the opposite then, a positive output gap, which I've sort of just explained on the previous slide, but let's just take a look at this in a bit more detail. So this occurs when actual output is above the trend rate, okay, and that means that we've got high levels of demand, and so there are likely to be inflationary pressures, okay. However, as a result of that higher demand, cyclical unemployment is likely to fall, because we've got more demand and more businesses are likely to then be moving into that marketplace and thinking, right, we've got an opportunity to be able to sell some of our goods and services, and as a result move into that position. So at this point then, if our economy is in a boom and operating at point Y, firms are likely to employ more workers to meet that increased demand. And that is going to mean that cyclical employment will fall. However, inflationary pressures would potentially impact on the economy. Okay, so effectively, more demand. We've got potentially demand pull inflation, because we've got significant amounts of demand that at the moment we're not satisfying. Okay, so last thing then to look at is the conflict between fiscal policy and inflation targets. One of the things that we need to bear in mind is that government could increase government taxation in order to reduce demand in the economy and so reduce inflationary targets or inflationary pressure. So in the short run, this might have the opposite impact, i.e., we could get raising VAT on goods and services. That will see an initial increase in prices and therefore inflation. Okay, so if we're talking about an indirect tax, that may actually cause a little bit of an issue in terms of our inflation targets. However, in the long run, if the price rises will mean that there is likely to be a fall in demand for goods and services in general terms. That should mean a fall in the rate of inflation, and that should then justify the government's policy to use contractionary fiscal policy to help achieve that. Clearly going to be quite difficult to measure the exact impact in the long and short run, because a lot of this information is based on forecasts and then obviously either proven or not proven when you look at the actual figures. And clearly in this situation, the government would be expected to prioritise the good of the economy in the long run. Okay, so short-term decision making due to political pressures clearly not necessarily going to be the greatest thing for the overall economy, and sometimes you tend to find this sort of stop-go policies tend to happen when we're about to hit a general election, because the incumbent party might choose policies that are going to be popular with the electorate in order to get back into power. So let's take a look at how we might look at these policy instruments and how they might affect other variables. Okay, and when you're doing this, I want you to think about the AD and AS analysis that we've looked at, and also look for any interrelationships between the variables that we're going to take a look at. Okay, so using your understanding of economics and the consequences for AD and AS under these following areas, think about how a rise in interest rates, what impact that might have on exchange rate, competitiveness, inflation, unemployment, and the supply side of the economy. Now, one could argue that's quite a good structure to think about. If you had a question which was to do with the rise in interest rates, if you could consider each one of those and write a paragraph on each, that's demonstrating that you've got a significant handle on how, in this case, policy instruments might affect AD and AS. Another example could be an increase in the level of government spending and how that might impact on the amount of money in the economy, the interest rate, competitiveness, inflation, and also unemployment. So again, that gives you some structure to sort of think about, and also just developing a paragraph in each of those areas, just so that you can demonstrate that when a relatively simple statement is given, you can then expand on that and talk about how that might have impacts on certain key variables in the economy. So that's what we've been looking at. We've covered quite a lot of ground there, because we've not just talked about fiscal policy and monetary policy. We've also looked at a range of different scenarios. We've looked at AD and AS diagrams and how you can illustrate both demand side and monetary policy, both expansionary and contractionary, and that hopefully gives a pretty good summary of all the things that you would need to consider when it comes to demand side policies. So thanks for listening once more, and I'll catch up with you soon.